Hey everyone, welcome back to Corporate Decoder. Today, BlackRock MUNIASSETS Fund Incorporated just filed a prospectus supplement for a rights offering, and I am seeing a strategy that could really dilute your stake. Quick note, this is not financial advice, just my take on public filings for educational purposes. This rights offering could mean your ownership in the fund gets smaller, and even if you participate, the value of your shares might drop if the price isn't right. Alright, let's dive into this filing from BlackRock MUNIASSETS Fund Incorporated, ticker symbol MUA. They are issuing transferable subscription rights, essentially giving current shareholders the chance to buy more shares. Think of it like a special sale for existing owners. The goal is to raise more money to invest, which sounds good. But there are definitely some things to watch out for. The filing lays out an estimated subscription price of $10.04 per S-share. This is important because it is how much you'll pay to buy these new shares through the rights offering. Now, they're basing this price on 90% of the fund's net asset value, or NAV, on a specific date. The NAV is basically the fund's total assets minus its liabilities, so buying at a discount to NAV can seem attractive. Here is a key detail that benefits the fund itself, but maybe not you directly as a shareholder. The filing clearly states that the advisor, which is BlackRock Advisors LLC in this case, will pay all the expenses related to this rights offering. This means the fund won't have its assets chipped away by the costs of printing documents, legal fees, or other administrative stuff for this offering. Those offering expenses, estimated at around $324,847, are on the Advisors tab. Now let's get to the heart of the matter, dilution. This is where your ownership stake can shrink proportionally. If you are a shareholder on the record date and you don't fully use your rights to buy more shares, your percentage of ownership in the fund will automatically go down. Imagine a pizza if more slices are added. Your original slice becomes a smaller piece of the whole pie, even if your slice itself didn't change. This dilution isn't just about ownership percentage, it can also affect the value per S-share. If the price you pay for these new shares, the subscription price, ends up being lower than the fund's net asset value per S-share on the expiration date, then the NAV per S-share for all shareholders. Even those who don't participate could actually decrease. This is because more shares are being issued potentially at a discount, which can drag down the overall value per S-share. To illustrate this dilution, the filing provides a scenario. If the NAV per S-share is $11.16 and the subscription price is $10.04, this example suggests a potential reduction in NAV of about 2.51%. That might not sound huge, but imagine that happening to your entire investment. If you had $10,000 invested, that 2.51% drop would mean losing around $251 in value simply due to the structure of the offering. It is crucial to understand that this is just an example, and the actual dilution could be more or less depending on market conditions. There is another risk here related to the market price. Shares of closed-end funds like this one often trade at a discount to their NAV. This means the market price on the stock exchange can be lower than the actual value of the fund's underlying assets. The filing points out that if the subscription price you pay for these new shares ends up being higher than the actual market price on the expiration date, then the rights themselves might become worthless, and anyone who exercised them would immediately lose money on the deal. Now, let's talk about leverage. The fund uses borrowed money or other forms of leverage to try and boost returns. The filing mentions that after this rights offering, the fund's leverage will actually decrease. While leverage can amplify gains, it also amplifies losses. So even though it is going down, it is a reminder that the fund's performance is tied to how well it manages this borrowed money. Fees are always a big part of investing. This fund pays its advisor, BlackRock, a management fee. It is set at 0.55% of the fund's net assets, plus any money borrowed for leverage. This means the more assets the fund has, and the more it borrows, the higher the fee the advisor gets. It is a common structure, but worth noting how it ties advisor compensation to the fund's size. Looking at the expense table, the total annual fund operating expenses are listed as 2.63% of net assets. This is a significant number. For every $1,000 you invest, you are paying about $26.3 each year in fees and expenses. While some of these might be waived or reimbursed temporarily, it is a constant drain on returns. The filing also touches on other expenses, which are estimated to be 1.83% of net assets, combined with management fees and other costs. These add up. The numbers here are based on assumptions, like the rights offering being fully subscribed, meaning all the new shares are sold. If not all shares are bought, the expense ratios could change. An interesting note here is that the total annual expenses in this filing don't perfectly match what is in the fund's most recent annual report. They mention this is because the other expenses have been restated to reflect current fees. This is normal as fees can change, but it is a good reminder to always check the latest filings for the most up-to-date expense figures. To sum it up, this rights offering from BlackRock MUNIASSETS fund is a way for them to raise capital. However, for existing shareholders, there is a real risk of dilution, meaning your ownership stake and potentially the value of your shares could decrease. The fact that shares of closed-end funds can trade at a discount to their net asset value adds another layer of risk. If you don't exercise your rights, your proportional ownership shrinks. If you do exercise them and the market price isn't favorable, you could lose money. The high overall expenses of 2.63% also mean a significant portion of your investment is going to fees before you even see any returns. My biggest concern here is the potential for substantial dilution, especially if the subscription price ends up being higher than the market price on the expiration date, or if the fund's NAV per S-share decreases. After the offering, the historical performance of similar rights offerings, especially for closed-end funds trading at a discount, often shows a period of further decline in stock price post-offering as new shares dilute existing holders and market sentiment shifts. For example, when Kodak did a 1-for-20 reverse split in 2021, holders saw roughly a 40% additional drawdown over the following 90 days. A $1,000 position there became about $600. While this isn't a reverse split, the dilutive nature and the market dynamics are concerning. What I am actually looking for is to see if the fund can successfully deploy this new capital at a profit to offset the dilution, which historically has been a challenge for many funds after large dilutive offerings. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Hit like and subscribe if you found this helpful, and join our community Discord linked below.